What exactly is banking as a service? Folks, fellows and partners in crime, let me welcome you to another session of the Finance Real Talk. Today we will have a quick and dirty ride through the world of banking and get some insights about what could be the best thing since sliced bread. The best way to explain banking as a service is by means of an example. Imagine for a moment that you are the manager of a car rental service. You are facing stark competition and you would like to strengthen your customer loyalty. If you could offer your customers, say, a debit or a virtual card, you could award them loyalty points whenever they pay with their card. Then, each time your customers use their card, they would interact with your brand. By analyzing your customers' spending behavior, you could understand them better and offer them more tailored services for their next purchase. Or what about if you offer your clients a kind of consumer loan if they need to rent a car for a longer time, or even if they would like to buy it directly on your website? This way, your clients could finance their purchase without ever having to interrupt their customer journey. You could increase the number of rides you sell and directly influence the amount your customers spend. A loan also represents a much closer customer relationship with far more touchpoints and data than just a single sale. There are dozens of ways of how non-banks can improve their customer experience and boost their revenue by offering their own banking services. However, if you want to offer banking services, effectively every government in the world requires you to own a banking license. And due to the systemic relevance of banks to the functioning of the economy, such a license is difficult to obtain. Acquiring a license imposes not only significant capital requirements, but more importantly compliance with strict regulations on money laundering, banking secrecy and deposit protection, to name a few. This is where banking as a service comes in. Banking as a service, or BaaS for short, describes a model in which licensed banks integrate their digital banking services directly into the products of other non-bank businesses. This way, a non-bank business, such as our car rental example, can offer their customers digital banking services such as mobile bank accounts, debit cards, loans and payment services, without needing to acquire a banking license of their own. The bank's server communicates via APIs and webhooks with that of the car rental, enabling your customer to access banking services directly through your car rental website or app. Your car rental never really touches the customer's money, it acts simply as an intermediary, meaning it is not burdened by any of the regulatory duties a bank has to fulfill. Thus, with BaaS, pretty much any business can become a banking provider with nothing but a few lines of code. That's why BaaS is also often referred to as white label banking, since the banking services are delivered through the branded product of the non-bank. Next to Solaris Bank, other providers in Europe's growing BaaS landscape include Clearbank, Rails Bank and Starling Bank. Across the pond, established banking giants are also launching BaaS projects next to their existing offerings, such as BBVA in the US. Is banking as a service the same as open banking? No, not really. The two models often get confused, as open banking also involves banks connecting to non-banks via API. However, the models serve entirely different purposes. In BaaS models, non-bank businesses integrate complete banking services into their own products. In open banking models, on the other hand, non-bank businesses merely use the bank's data for their products. In the industry, these non-bank businesses are called third-party service providers. Maybe it makes sense to have another example for this. Financial management apps are prominent third-party providers, so-called TPPs, that benefit from open banking. They aggregate information from all of your different bank accounts into one application, enabling you to better oversee your finances. This can help you achieve savings goals or improve your spending habits. In order to aggregate the information, the app needs to draw transactional data from all of your bank accounts. It does this via an API integration to the bank's systems. Often, this API integration will be provided by another party. They are generally categorized as API banking platforms, and can be considered as the middlemen connecting the banks with TPPs like the financial management app. They provide the actual API layer that sits on top of the bank's system that enables the flow of data between the bank and the TPPs. There are many other use cases for open banking. The second EU Payment Services Directive that came into action on the 15th of September 2019, better known as PSD2, makes it mandatory for banks to open up their data to third-party service providers, with the intention of proliferating these use cases. The key thing to remember though, is that different to BaaS providers, the TPPs are not able to perform banking services, such as lending or taking deposits, as they don't hold full banking licenses themselves. They are simply repurposing account information from your existing bank accounts to provide insights or trigger transactions. And what about platform banking? Where does that fit in? Platform banking is a different story altogether. This refers to banks that integrate services from other fintechs to augment their existing offering. So, for example, a bank might integrate a robo-advisor into their app to enable their customers to access investment products from the same account from which they do their day-to-day banking. Platform banking can thus be described as the inverse of banking as a service. In the platform banking model, the bank owns the customer and integrates services from fintechs. In the BaaS model, the customer is owned by the fintech non-bank and integrates services from the bank. Banks often use the platform banking approach as a defensive strategy to prevent losing their customers to savvier fintechs. By integrating the fintech services into their platform, they can at least keep their customers in their ecosystem, even if it means handing over the lion's share of the revenue to the fintech. We do stop all the different explanations by now and should sum up all the different types of banking we have touched in today's video. Banking as a service, what it is, that are licensed banks that enable other businesses, could be other financial institutions or non-financial institutions, to integrate digital banking and payment services directly into their own products. How it works: the business front end is connected to the BaaS provider via API, allowing the business to offer digital lending services, account management and payment services themselves in their own apps and websites. The business owns the client and the BaaS provider owns the accounts. Open banking providers, aka third-party service providers. What it is: non-banks that access data from their customer's bank account to provide account insights or trigger payments from within an app or website. How it works: the open banking providers connect to the bank's system via API to retrieve the data. Often, the API layer between the bank and the open banking provider is provided by an API banking platform. Platform banking, what it is: banks integrating services from other providers, mainly fintechs, in order to offer their customers a broader range of financial services from one bank account. How it works: depending on the type of setup, the fintech services are usually fully integrated into the bank's app, web page user interface via APIs. Hope that you enjoyed today's content and you could get some valid insights out of this. Would be great if you could push the like button, and if you also subscribe to the channel to get more insights and informations like this, to get up to speed about all the things in the beautiful world of finance. Take care, stay